Hello, YouTube. Boo. All right. This is a Chapter 7 practice test. We're going to walk through. What? We are going to be doing a income statement and a balance sheet. They have provided for us a partial 8-column worksheet. If you remember from Chapter 6, they give us the sales and expenses. That's our income statement accounts. And then our assets and liabilities and owner equity. That's our balance sheet accounts. So the first part says, prepare an income statement for the month ended January 31st of the current year. Figure out the component percentages for the total expenses and net income. Round to the nearest 0.1. So let's do the income statement first. That's going to be this part. The difference between the income statement and the balance sheet is the amount of columns. Ignore this solid line here. So the income statement has a big column for all the account stuff, 2 columns for the numbers, and then sales, percentages. And then the balance sheet has big column, numbers, big column, numbers. So the first part, 3-line heading, the same as any other 3-line heading. What always goes on the top line of the 3-line heading? The name of the
Service.
business. Good. So this is Mary, Martha, catering service. Martha. It's Martha. Like Bertha. What goes on the second line of a three-row heading? I know. Income statement, or the name of the doc. This doc is called income statement. Then you put the date. So this is for 1-31-18. If you wanted to, you could do both of the headings first. Yeah, either way, I wouldn't mark it wrong. You could put for the month ended January 31st, 2018. Let's go ahead and do the 3-row heading for the balance sheet since it's fresh in our mind. First line, Mary, Martha, catering service, balance sheet, and then this is for 1-31-18. So that in and of itself is worth 6 points. All right. Now let's do the income statement. The income statement has 3 main headings. What is the first heading? Revenue. Good. Revenue is what a business does to create income. So how many sources of revenue does this company have? 1. If you look at the income statement, it has 1 source of income, which is sales. Okay? So you write sales, and then you write the sales total, which is 4,500. That goes in the right column because it is a final balance or number. What is the next section? Expenses. Now you list your expenses. So there's ad, insurance, miscellaneous, rent, supplies, and utilities. List them with the balances, and then you're going to add them up. So ad, insurance, MISC, rent, supplies, and utilities.
Get the right expense after all of them.
I'm not going to. Now, if your boss said, hey, make sure you list those as expenses. Yeah. So, list your expenses and their balances. So, the ad expense is a hundo. Insurance is a hundo. Misc is 50. Rent is 7 hundo. Supplies is 2,100. And utilities is $300. So, once you have completed listing your expenses and their balances, you're going to total them up. Somebody tell me what the total expenses are, please. You're going to write 3350 in the final column, the right column. Total expenses 3350. Now, hopefully, you added these up and got 3350, or on the 8-column worksheet, because remember, we had to make sure everything balanced and everything was good. You actually have total expenses right here. Because if you remember the 8-column worksheet, you take sales minus total expenses to get net income. So 3350 is the total expenses. They just don't actually write total expenses. So you can like check and double check to make sure you're good. So now I have all of my sales, all of my expenses. When I subtract these two, what am I finding? Net income. Whoa. And so what is the net income? 1150. Good. So net income is 1150. The next thing you have to do is the component percentages. The component percentages are that so you can find out when you make a sale how much of it goes toward profit or income and how much of it goes toward expenses. I use the example of a Snickers bar. Let's say you buy a Snickers bar for 40 cents and then you sell it for $1. So 40% goes toward the expense and 60% goes toward the net income. So if someone said, hey, how much would you make if you sold 1,000 Snickers bars? You would take the 60% times it by the 1,000, you'd make $600. So you can extrapolate the data to figure out net profit and expenses. So to find the percent of sales that makes up sales, you do 4,500 divided by 4,500. When you do that, you end up with 100%. Wow. Now, if, let's say this company had repairs and sales, and it was like sales was 4,500 and then repairs was 4,500, the total sales would be 9,000, but each of them would make up 50% each. So there could be a difference, but there's not in this one. We get down here, you have total expenses is 3,350. So do 3,350 over 4,500, and that'll be your component percentage for expenses. Looking at it right now, this looks like about 70-ish percent, 72, 73%. But go ahead and divide that out. Tell me what you get. 74 point what? 74.4%. Excellent. And then the next one, the percent of net income that comes from sales is going to be 25.6. So the next thing that you could do to make sure that you have done this correctly is add these two numbers together. These two numbers together should equal 100%. If they don't, you got a problem. So let's do this real quick. What if I told you you had sales of $9,250, and I said, how much net income do you expect to make? What would you do?
I'll multiply that by 0.7256.
So let's do that right now. 9250 times 0.265. Whoops. 256. 2368. So all you're doing when you do these component percentages are trying to figure out like profit margin and how much money you would make if you had certain sales. So you could do that with any number. Say if you had 10,000 in sales, you would make 2560. So you could do that and just find those numbers. That's beneficial for a business because you can project, bless you, how much money you expect to make. Some companies will have like standards and they say, if we're not making at least 30%, we're screwing up, we're doing something wrong. So then they would need to change and make less or spend less expenses. But anyway, that is that part. What questions do you guys have on the income statement portion? 0. Excellent. Sado. Muy bien. Me gusta café. No comprende. El gato pantalones is caliente.
Yo, this chick walked into Waz's room this morning, or not this morning, like Friday morning, and they both had like a full-blown conversation.
Really? Was it cool?
Him and Bradley Jacobs used to have full-on conversations.
Yeah.
Yeah. Yeah, he was like,
Right. That's funny.
Oh, yeah.
My dad was like, how do I talk to him? Eddie was like, no, I'm just playing. He was like, what's up?
Hello. All right. For the last part, we got to make a balance sheet. We're going to use these accounts: assets, liabilities, and owner equity. If y'all remember to chapter 1, if you've been watching my videos since chapter 1, you remember that assets equals liabilities plus owner equity. That is the accounting equation. And we're now calling back to that in chapter 7. So what we're going to do is list our assets in one side, our liabilities and owner equity in the other side, and see what happens. So we got our 3-row heading: name of the business, name of the document, the date. Now we're going to do assets on the left, liabilities on the right, and then we're going to list all of our assets. So we got like cash, petty cash, ACREC, supplies, prepaid insurance. Then once we get to account payable, we're no longer at assets. So cash, 7,000. Next one is petty cash, $75. Next we got ACREC Jan's Cakes. $7.50. We got supplies. Supplies are $11.25. Then we got prepaid insurance is $400. After you list all of your assets, you total them up, and you call that total assets. So someone total those up for me. Tell me what you get. What do we get? Good. $9,350 worth of assets. So this company has $9,350 worth of good stuff to their name. Now we get over to the right side, liabilities. If you recall, liabilities are when you owe money to somebody. So in this person's books, we have an account payable to Ken's, and it's for $1,500. So ACPay, Ken's. Ken's is a $1,500 liability, and that is it. ACPay Ken, $1,500. That's it. So the next one would be total liabilities, which is $1,500. Kind of redundant, but you're supposed to list it anyway. If you had more than one account payable, you would add them together and then call it total liabilities and put the sum of those numbers. Next part, we have capital. Capital is going to include capital, drawing, and the net income. You can do that a couple different ways. We'll do the long form first. So, center the word owner equity. That is your next category. You had assets, liabilities. Now you got owner equity. The owner equity for Martha Free Capital is $6,800. So if you take a look at the 8-column worksheet, Martha Free Capital, $6,800. So that is the amount in the ledger at the start of the month. However, you're going to make some changes to it. Now we're doing this at the end of the month. The changes we're going to make is we're going to add net income and subtract drawing. So the next line, you're going to write net income. And our net income, remember from the income statement, is $1,150. And then drawing on the 8-column worksheet is $100. And if you remember, drawing is a withdrawal of money by the owner. So the owner is taking money out. Martha drawing. And you put it right underneath the net income. Then you put a little line, and you put the difference of these two numbers, net minus drawing, right underneath where the capital would have been, or is going to be, and then we're going to add those up. So $1,150 minus $100 is going to be $1,050. So the new Martha Free Capital is the sum of these two numbers, which is $7,850. And that number goes right here. So the total kind of closed out owner equity section is $7,850. The last line, did I do that right?
Yeah.
No, we're going to do another line for total liabilities and owner equity. You could have done it. You could have skipped all of this and just done capital plus net minus drawing, because this number is capital plus net minus drawing.
Do you even have to reiterate the capital? Because last time I did it, I didn't do it. And I was like, wait, I was checking that one.
Yeah, like You could have just wrote owner's equity and then not even written this part and just written 7850. Like
Oh, really?
some accountants will just do it. What's that? Yes.
Put the drawing in there.
Like that's what I called this the long form. If you did the short form,
You could put owner equity and then put
Martha Free. Yeah, here, let me show you how it would look. Owner equity centered. So this is the other option. Owner equity. Martha Free Capital. And then you would do 6,800
plus 1150.
plus 1150 minus 100 equals 7850. So you would write 7850. And then your last line is total liabilities and OE. And then you would add this and this. Pretend that doesn't equal, or that doesn't go there. And you get 9350. Oh, which means your balance sheet balances, assets do in fact equal liabilities plus owner equity, way back from the first chapter, ALLO, and you double line it. And then if you're an actual accountant, you're almost done with the end of the month documents. There's one more to do, which we'll be doing next chapter. All right. Accounting man out.
Stanley, you have